All right, so today we're just going to be talking about the 10-year T note. And it is, I think, remarkable because we are at the 50-day moving average in a deeply oversold treasury market. So basically, the thesis that I present here is that this will change the dynamics with the NASDAQ, growth stocks, technology stocks, which obviously are sensitive to interest rates. So here's a graph. Black is the NASDAQ, blue is E-minis, the S&P. And you can see we outperformed through the second half of last year and then basically have been underperforming since. If we do a 6-month, you see the underperformance is even worse. So let's call it 7% over the past year underperformance, but more like, what is that, 11.5% over the last 6 months. So basically, since the top of the market, the NASDAQ is down 11.5% more than the S&P. Part of that's the beta, meaning it's more volatile, but part of it is underperformance due to sensitivity to interest rates. And as interest rates have spiked, interest rates go inverse to the price of the 10-year. The NASDAQ has really suffered. So basically, the bond market is finally starting to rally in, I don't know if I'd call it the recognition of a recession, but it's sort of at least recognition of a growth scare. And I don't expect, well, actually, I do expect treasuries to make a very substantial move back to like the 127. Let's take a look at a longer term chart, back up to this like 127, 128 area, right? This weekly 5-year, weekly 50 week moving average. So I do expect a large move, and that move would come again as the bond market recognizes that we are entering a recession. In the short term, I think that we won't see that. I think we will see, I'm not going to say weakness, but I think we'll see just going kind of trending along the 50-day moving average. And I think you're going to find at the same time that that downward or sideways to downward move in the bond market is going to be accompanied by a relief rally in the NASDAQ. So that's my short-term view. I do think the stocks will make another low this year, like in October, maybe sooner. Could kind of just grind down throughout the summer, but I would take off any sort of trades where I'm undervaluing, so basically selling growth stock ratio trades. So if you're short growth stocks along the main index like the S&P, I think it's time to take that ratio trade off or even reverse it. So I think we'll see weakness, but I think we'll see equivalent weakness in the broader market from here on out. And in the short term, I do think that we are at or approaching a bottom in the stock market. All right, that's all for today. Thanks. Bye.